afternoon, everybody. For those I haven't had the pleasure of meeting, my name is Mike Moe. I'm co-founder and CEO of GSV Capital. On behalf of my colleagues, I'd like to welcome you to our third annual Investor Day. We're very excited about the program in front of us. I'm going to give some comments and we're going to turn it over to the CEOs of some of our portfolio companies. But again, everybody's time is precious, but we think we've got a great day ahead for you. Just in terms of some context, GSV Capital has now been public for 5 years. We took this idea public in May of 2011 with the simple proposition that we wanted to create access for public investors to leading VC-backed private companies. And for the companies themselves, we wanted to provide liquidity and growth capital. And in fact, if you look at the portfolio that we've created, we're very proud of the companies that we've been able to get into the GSV Capital portfolio. So just quickly, in terms of 2015 in review, last year we were delighted to be able to distribute $54.2 million in net realized gains, a $2.76 dividend. We also, in terms of milestone in 2015, we were able to get RIC approval, which is a future benefit for our shareholders. We made investments, continue to make investments in the leading game-changing companies that are truly transforming society as we know it. Spotify, Lyft, Coursera, most recently Snapchat. Also, we survey our portfolio companies in terms of how they like working with us and what kind of value we provide. We received a 43 net promoter score from our portfolio companies, which we'll strive to continue to improve, but we thought that was a good start. As I mentioned, we're 5 years old. We've learned some lessons, and so some of those lessons I want to share with you today, as we think that those lessons well learned are going to benefit our shareholders going forward. First lesson: focus on emerging growth stage companies, Series B and beyond. What we said from the beginning is we envisioned creating a portfolio of 90% emerging growth, 10% early stage. And while the early stage investments have performed as we would expect early stage investments to perform, what we've determined is, one, just creates too much noise in the portfolio, too much volatility for a public stock, even though they're smaller positions. The second piece, which is probably more important, is we see the opportunity for investing in later stage VC-backed private companies is huge, enormous. 5 years ago, we thought we were onto something. Today, I can tell you, it's an enormous opportunity for us to execute against, so that would be our focus. Secondly, don't buy shares too close to the IPO. That's a lesson that we learned because what happens is it's really a seller's market, so there's not a margin of safety that we think is important for people that we think of our primary skill set as being growth investors. Three, we're agnostic between buying primary and secondary shares, but we know that we have competitive advantages in buying secondaries. And part of that is just more difficult to do. A lot of investors that invest in private companies just won't invest in secondaries because there's less information, it's more challenging in terms of how you acquire shares, etc. And what we found is that actually is to our advantage in the market that we're in today, where there's a lot of sellers and less buyers. Particularly, we like to think there's advantages in the secondary area. Four, avoid lead investments and make sure that we have other institutional, top quality institutional investors involved. That really kind of goes back more to the first point about investing in early stage businesses. We love to be a great partner with top venture capital firms, like we've got Peter Bell from Highland Capital in the front row. We love investing with Highland Capital, for example. Five, sell when you have an opportunity at a fair price. I think we've done a good job of monetizing a bunch of our positions, both in the public and private market, but not perfect. And I think one of the lessons learned is, instead of being perfect in terms of trying to hold out for the last nickel, when you have the opportunity, whether it's in the private market or the public market at a fair price, you realize that opportunity. So Twitter's an example of where, the good news is we sold 2/3 of our Twitter position. We hope not to repeat, but we think those are important as we look forward. We're trying to create unfair advantages for both accessing great companies and adding value for those companies. And so you're at GSV Labs. This is our accelerator platform that we think both gives a great window to future opportunities as well as interesting partners. We also put out a weekly piece called A to Apple, which is really organizing our investment thoughts and provide that to the marketplace, both to show what we think and what we know and what we care about, but also as a way to create advantages as we look ahead to get to the best companies in our portfolio. 7, being right in the fundamentals is more important than being perfect on valuation. That really gets back to the point about we really think that we have confidence in our ability to invest in growth companies and the fundamentals of being able to have high and sustainable growth. And so we found it's much better to own a great company at a fair price, or maybe even a slightly high price, than to have a not premier company. So again, we're focused on investing in the very best private companies in the world. Create our own research rather than rely on experts and pundits. And we believe that one of our key assets, advantages, is that we're by nature research people. We think research is the foundation of investing. And we want to use that skill set to our advantages as opposed to relying on other people that we might not even have as much confidence in. That's not to say we won't get other input, insights. We research, we do. What we want the foundation is really the research process that we've created over a number of years. 9, short-term market volatility creates long-term investment opportunity. We're certainly seeing that in the marketplace that we're in today. For example, we were able to buy the Spotify shares that we bought at the end of last year because we saw an opportunity to buy what we think is one of the premier growth names in the world at about a 25% discount to where their last round of financing was done. Ironically, that impacted our near-term net asset value, but we think in the long term it's going to benefit our shareholders greatly. And number 10, and probably most important, is that it's all about people. Great teams find a way to win. And so the more that we just re-emphasize that point, the more we think we'll be successful for our shareholders, because it is ultimate. It's not, the idea is important, but it's all about the execution against that idea. So current state of play for the portfolio, we have 47 investments, $243.1 million in net value, $10.96 per share of NAV. Just to remind you, our stock price is about 5 and change, so we're selling at more than a 50% discount to NAV with a portfolio that we think is outstanding. You look at the growth rate of the portfolio, we believe that growth is what drives enterprise value over time. The portfolio has very robust growth characteristics. 2015, the revenue growth year over year for the portfolio was 104%. We expect similar growth rates for this year. And back to the point about emphasis on emerging growth stage investments, 91% of the portfolio is in B round and beyond. And 2/3 of the portfolio today is in primary share investments. As I mentioned, I think that you should expect, certainly if the environment continues, that you'll see us buy more secondary. Secondary will become a bigger weight just because, again, we think we have advantages doing that. Today, there's 5 main themes that we've focused on. Big data and cloud computing being the largest, 33%. Education and technology at 30%. We have social mobile at 18%, marketplaces 13%, and sustainability 6%. There's some themes that we're monitoring and probably will pop in terms of an emphasis in the foreseeable future, but that's what it looks like today. And back to the premier venture firms that we've been involved with. We believe it's important to invest alongside and behind the truly great venture capital firms. Looking at the top 10 positions of our portfolio, we really have a barbell approach. So the top 10 positions are 54% of the portfolio. Palantir being the largest position at 14.2%. One thing that we do is just the way we operate is typically we'll take a position to get on a cap table of a company, and then if we like what's going on with the fundamentals, we'll look to add to that position. In fact, of our top 10 holdings, every single position, that's what we did. In some cases, we bought multiple times. Some cases, we bought 1 or 2 times, but that's what we typically do. We buy, and then we'll continue to add as we see the opportunity present itself. For 2015, we had $64 million in total gains, offset against $10 million in losses. IRR total about 31.7%. Again, if we can continue to do that, we think that will be very beneficial for our stock price ultimately. It was comprised of $26.9 million of gains from Twitter, a 40.9% IRR, 2U, $37.2 million of realized gains, 65.1% IRR, And then the losses, there's some other smaller gains, and then the losses shown here. For 2015, we made $31 million of new investments. That was comprised of $10 million in Spotify, which added to the position that we already have. So now we have a $16.2 million position in Spotify, which is our third largest investment. We're very excited by Spotify. We think it is revolutionizing the music industry. It's certainly the leader in social music, which by nature, music is social. Today, Spotify has about 100 million users. What's really interesting, it's a freemium model. 30 million of those users actually pay for it, which we've never seen a freemium model where that high percentage actually pays for the service. What's even more remarkable, you look at the demographic of Spotify, 50% are under the age of 27, yet the churn of that subscriber is almost negligible. So over the last 5 years, you still have 70% of the people that subscribed in 1970, or 1970. In 2010. And so for a young demographic, I got two daughters just out of college, they'd rather have the electricity turned off in our house than the Spotify account. Enjoy is another investment that we added to last year with a $4 million investment. Our friends in Highland were the lead in that round. That total Enjoy investment is now $5.4 million as at the end of the first quarter. What Enjoy does, it's led by former head of Apple stores, Ron Johnson, who will be presenting later. Effectively, it's Genius Bar meets Lyft. So you go to the Apple Genius Bar to get help with your technology. What Enjoy does is bring that experience to your house, to your office, to the coffee shop. The technology that you bought online, they'll get it set up for you, ask the questions. We think it's a brilliant idea, and we're very excited about the growth and potential. Declara, we added the $2 million to our position last year. What Declara does is creates knowledge networks for organizations, effectively sharing information and knowledge. And so now we have a $12 million position in Declara. Recently, Declara CEO Mona Pearson was at the White House. What President Obama said was, this is Google meets Facebook. And I don't know if exactly Google meets Facebook, we like the description, so we use it. But here's what he actually said at the White House in the conference they had.
So today, Declara has users all around the world. It's attracted millions of dollars of capital. They've got teams 65 and 30, with women serving as CEO, COO, and head of data science. That's the power of a good idea.
And that's the power of a good idea. Pay Near Me, we added $4 million to the position that we have, giving us a total of $14 million in Pay Near Me. We have Danny Shader speaking after I'm done, who's the CEO of Pay Near Me. What Pay Near Me does is creating payment networks for the unbanked. And you think, the people that don't have a bank account are underbanked. What's interesting, in the United States, there's 93 million people who are unbanked or underbanked. So that's how they have to be able to pay their utilities, their car payment, their rent. And what do? They go to Pay Near Me. A lot of them are in 7-Elevens where this demographic is comfortable with. Lyft, we added $2.5 million to our Lyft investment in 2015. That gives us fair market value of $14 million in Lyft. We also took advantage of a very fast appreciation in our Lyft shares to sell some Lyft, which was catalyzed by a $1 billion Series F led by General Motors. Lyft is really a pretty exciting company, and one of the things that they're doing that's very smart is they're focused on the United States, but they're getting exposure around the world, having partners basically with the people competing against Uber in every important market. So Ola in India, Grab Taxi in Singapore, Didi in China. It's a business that's very, very exciting. GSV Labs, where you are today, I'm going to talk more about GSV Labs when I conclude my remarks. But we think GSV Labs has enormous potential, and what I want to stress for the people here is that as a shareholder of GSV Capital, you actually own 75% of GSV Labs. And so when I talk about this in a little bit, think about what I think that could mean for our shareholders. So that gives us approximately $7 million of economic value that we've attributed basically what we've invested into GSV Labs. And we'll talk about this in a little bit because I think you'll see that we think the value is quite a bit different. Some fundamentals for our opportunity in terms of supply demand. This is a little bit of a refresher, but it's really important to understand the fundamentals that are going on here, because if anything, it just get more pronounced. So fundamental one is, historically there was a robust environment for IPOs, small companies with huge potential, because they often went public early in their life cycle. There's 4 to 6 IPOs on average per year for the decade of 1990s. The last 15 years, on average, there's been 111 IPOs, so almost a reduction of 80%. Last year, there were 77 VC-backed companies that went public, and that was the largest number in nearly 10 years. By the way, year to date, I think there's 2. In terms of the characteristics of companies going public, the average amount raised in an IPO during the decade of the 90s was $32 million. It's $245 million. Today, the average market cap of a company going public is $1.1 billion. Much larger, much more mature businesses going public today. The time to monetization for a venture capitalist has gone from 3.1 years in 2000 to approximately 10 years today, so more than triple. The average number of companies VCs have invested in the last 15 years is 3,200. So in other words, very few IPOs, but the venture capital community hasn't quit investing. If you look at last year, in fact, there's 3,709 companies, venture capitalists invested in the United States alone. Here's a really interesting statistic. Because of that fact that you had very little of that backlog burned off, you now have 2,000 VC-backed private companies with $100 million or greater value. So effectively, the way that we look at this funnel is there's 35,000 companies that have been invested in the last 10 years. We think there's probably 16,000 of them that are alive some way. Of those, 2,000 have $100 million greater market value. That's our focus. Of those, about 250 are where we actually have created research and started to determine where we might have an interest in. Of those, we have a priority list of about 25. Effectively, we're doing the NFL draft and what we pay. So that's the process, and that's the opportunity. We think that's pretty significant. So effectively, the way to think of it is we think the power alley for our strategy is where companies used to go public in the good old days and where they go public today. And that's a gigantic opportunity. Another fundamental in the supply-demand equation is that corporations have enormous amount of cash, $1.9 trillion recently. So just to put some context on that, that's larger than the entire GDP of India. Another way to think about $1.9 trillion. If you add up Facebook, Apple, Google, Amazon, and Microsoft, it's not $1.9 trillion. It's a lot. And these technology companies, there's a massive consolidation going on, with the big 8 basically having acquired 504 companies in the past 5 years, spending $112 billion. Another supply-demand dynamic. You have publicly traded companies in the U.S. the last 20 years is basically cut in half. So the dynamic here is scarcity of equity, of opportunity to invest in these rapidly growing companies. At the same time, what you're having is a steep innovation curve that's taking place in Silicon Valley and the global Silicon Valley that we're quite excited about. So if you look at this innovation curve, what you're seeing is it's accelerating. And so the magic of Silicon Valley isn't about bits and bytes and chips. What it really is about is taking big ideas and making them go exponential in terms of its growth. And so if you look at the automobile industry and you look at why there's been so little innovation, it's not because they didn't spend money. General Motors spent $7.2 billion last year in R&D. And what did that R&D get them? The Cadillac electronic car that basically goes 35 miles before you have to recharge it. BMW, the ultimate driving machine, gets to go 81 miles. And then comes along, Elon Musk, not encumbered by industry knowledge, but basically reconceptualizing what could happen, kind of what Steve Jobs did with the mobile phone industry. And he introduced the Tesla Model S, highest rated car in the history of the automobile market, doing 265 miles before you have to recharge it. Effectively, you're driving a computer on wheels. So General Motors was on this linear innovation curve, and Tesla brought Silicon Valley magic to this industry. That's what we're tapping into. Now, soon at an intersection of the years to be self-driving cars. So we believe passionately based on years of research and experience, that in technology in general, and the internet specifically, it's all about investing in the leaders because there's disproportionate gain to the leaders within categories. Some examples of this. So we're really in a winner-take-all economy. Facebook is 160 times larger than next door. Google is 3 times larger than Bing. YouTube is 8 times larger than Vimeo. Amazon is 1,000 times bigger than Jet. And then you look at human capital. What's happening in human capital? The average CEO is making 303 times the average worker today, up from 23 times 45 years ago. In baseball, the average baseball player 45 years ago made about what the average worker made. Today, they obviously made $4.3 million on average. So as we look at investment opportunities for GSV Capital, we often think the biggest investment opportunities is where there's a problem. The bigger the problem, the bigger the opportunity. In a global global marketplace, a knowledge-based economy, there's no bigger problem or opportunity in our view than how to more effectively educate the populace. As your education, your knowledge makes a difference not only how an individual does, but how a company does, and for that matter, how well a country does. Let me give you some fundamental, big, broad, industry second largest to healthcare, but let me give you some fundamentals of what's going on. So in 2000, you look at the United States of America, there were 4 states that had 50% or more of its student population being low income, which is really remarkable. The United States of America, wealthiest country in the world, actually 4 states had 50% or more of the students came from low income. Today it's 20 states, and if you took it to 40%, it's 39 states. What are the consequences of that? Low income students are 5 times more likely to drop out of high school. Dropouts are 8 times more likely to go to prison. And if you look at the prison population, 80% of the prison population is made up of high school dropouts. SAT scores, which is the golden ticket to get into the most prestigious universities, there's a direct correlation between your family, household income, and your SAT scores. So what the SATs effectively predicts is how wealthy your family is. Not coincidentally, when you look at the most prestigious universities, 75% of the students come from the top quartile of household incomes. And the flip side of that, when you go to the bottom quartile households, 8% of, if you come from a bottom quartile family, you only have an 8% probability of graduating from any university. So effectively, today, if you're born poor, you have a 70% chance of staying poor. This whole idea of upward mobility and the American dream has gone away. That's not sustainable. You can see it going on. This election, people are angry. People are angry because either their jobs are going away or they come out of college with $1.2 trillion in debt and they can't get a job. This is a ripe situation for solutions, for innovation, for Silicon Valley. So what I believe is that talent is equally distributed by zip code, but opportunity is not. So we talked about research being a foundation of our investment process. We put out a white paper called 2020 Vision. I don't know if there's still copies back there, but it really goes through the research and our thesis where the greatest opportunities are going to be created in that space. And so as we think about education innovation, historically, there's this linear curve. What we want to do is what Uber did to changing the ridiculous process of hailing a cab. We want to figure out, looking for companies that are changing the dynamics for how to more effectively educate everybody. And that's what we think the opportunity is. That's where this opportunity gap is. And what we're seeing from an opportunity standpoint is historically, it's very difficult to scale fast. You're seeing companies scale very, very rapidly. What we call weapons of mass destruction. So Newton is in our portfolio. Newton was founded in 2008. What the Newton creates is adaptive, personalized learning. Every single click, more individualized for that student. 10 million students on the Newton platform, 16 billion recommendations to date. Clever was founded in 2012. We're an investor in Clever with Sequoia. 20 million users in less than 4 years. Coursera is one of our largest positions, founded out of Stanford University. Rick Levin, the CEO of Coursera, will be here later. 18 million students on the Coursera platform with a freemium model, truly disrupting this industry. Second theme, sustainability. What happened with Moore's Law is now happening, what we call Swanson Law in the solar world, where actually the solar cost is getting the grid parity. We're an investor in a company called Selexo, one of our top 10 positions. Totally disrupting, we believe, $100 billion solar industry with the lowest cost product with the highest quality. So the good news about tapping into the sun, when it runs out of its juice, we have far bigger issues to worry about than our energy issues. Third theme, cloud and big data. Again, we're in a world where information and data is exploding. You see by the growth of companies like Microsoft and Amazon, AWS. So the last 2 years, more data has been produced than in the history of humankind up to 2014. Dropbox is our second largest position, 500 million users, huge network effects, 1.2 billion files uploaded daily, 15,000 business customers, effectively the Apple model. People use it as a consumer, and they brought it to their business. Powerful big data, adaptive software, becoming more individualized, personalized recommendations. Netflix gets 50% of its watches for recommendations it makes to its customers based on their previous experience, as well as what they've learned from other people with similar tastes. But big data has far more pronounced implications than just fun things to be able to consume. Doctors only have a 50% accuracy of diagnosing lung cancer, but IBM's Watson has 90% predictability. It's not predictability. Palantir, our largest investment, is a leader in big data and security software. Just recently, in December, raised $880 million of financing, and just a few weeks ago announced a major $222 million contract. Quite excited about Palantir. Marketplaces, Lyft, mentioned earlier, explosive growth, 300% year-over-year growth, 11 million rides just in April. So if you multiply 11 million rides by $20 a ride, you can see the kind of scale of business that Lyft is creating. Course Hero, another marketplace business, peer-to-peer. It's an investment that we're quite excited about, doing extraordinarily well with a very successful economic model. Social mobile, we mentioned that Snapchat is a recent investment of ours. In social media, the number 1, number 2, and 3 fundamental is engagement. Snapchat has extraordinary engagement. So the 100 million plus users that it has, most of those users use it every single day. In fact, there's 9,000 photos uploaded every second. 10 billion daily video views, 10 billion daily video views. So we think that's really pretty exciting. The last thing we'll talk about is virtual reality, which is one of these ones that's bubbling up. We have Jason Rosenthal. Oops, I was one ahead of myself. So this industry, with long on promise, is finally coming into its own. $90 million spent in the AR, VR world in 2014. It's now $5.2 billion by 2018. Lytro is a top 10 holding of ours, truly selling picks and shovels to the miners in the virtual reality world. You'll hear from Jason Rosenthal a little bit later this afternoon. So just in closing, I want to talk a little bit more about GSV Labs. We call this Silicon Valley 3.0, and we think this is a pretty important idea as it relates to value creation for the GSVC shareholders. So in 1970, Xerox PARC basically was launched and was effective at the same time when Gordon Moore came up with Moore's Law. And from Xerox PARC, a bunch of important things happened. It was where Steve Jobs got the idea for the personal computer, the graphical user interface, computer, mouse, Ethernet. All this was the result of Xerox PARC, which by the way was captive for Xerox Corporation. Here at GSV Labs, we have put together an innovation platform combining entrepreneurs, corporations, capital, education, all with that idea of accelerating innovation. So basically, this innovation platform has major corporations, startup community, and educational programs, all with that focus in mind. So there's 170 startups in this building. $200 million was raised for the startups here last year. We have partnerships. If you walk, and I encourage you to walk around GSV Labs today, we have partnerships with major corporations such as IBM, Intel, JetBlue, 3M, Google Developers Launchpad, Times in India. We've got Satya Goswami from Times Internet here in a little bit to have an interview with. AT&T. All major corporations tapping into Silicon Valley, tapping into what's going on at GSV Labs. So the economic model here at GSV Labs is we get corporate sponsorships, we have events, we have educational programs, and we get rent from the startups. We also, just as an example of the kind of things going on here and the value we think we're creating for GSV shareholders, is Reboot was launched, it was conceived here about a year ago by Dan Flynn, who is the Chief Marketing Officer. Effectively, what Reboot is a boot camp that has women that have left the workforce, often to raise kids, that want to get retrained so they come back into this dynamic workforce. They get connected and get confidence. Now, all this is going extremely well. So now Reboot programs are not only going on here, sold out for the rest of the year, but Chicago, New York, and interest around the world. Exciting. The last piece, how you think about GSV Labs, is increasingly, we had to fill the place up first, but increasingly we get economic interest in, through equity, through the companies here and the companies that will be down the road. So I look at that as creating a bunch of lottery tickets that are going to be building up over time. An example of this is we recently, a couple of weeks ago, announced that we would, in partnership with the Times of India, are going to open up 2 GSV Labs, one in Bangalore, one in Delhi. So in the first 2 weeks, we had over 600 companies apply to be part of that program. And we get 2% equity in each of the startups that are accepting the program. So just imagine how that looks as time goes on. So our vision, our game plan here, is basically to put GSV Labs in the major innovation centers around the world and be able to have thousands of lottery tickets with the best entrepreneurs. So just a little bit of context, and I appreciate that I'm 5 minutes over my time, and I don't want to sound too enthusiastic, but I am. So if you think about WeWork, which is a great concept that basically provides housing for entrepreneurs, and it has a $16 billion market value, about $250 million per center. So we think this is a more interesting model with little startups, equity interest, sponsorships, and a platform that we think we can grow around the world. And once again, you as GSV Capital shareholders own 75% of this. Effectively, GSV Labs is public today through GSV Capital. So with that, I'm very appreciative of you giving me the time